Welcome to today's deep dive. Today, we are going to be looking at a really interesting question, and that is, how predictable are humans when it comes to money?
It's one of those age-old questions, isn't it? I mean, is it all logic or is there something else driving the markets?
Yeah, it's a big one. And to help us unpack this, we're diving into Andrew Lowe's book, Adaptive Markets.
Oh, this is a good one.
Lowe really challenges some of those classical ideas around perfectly efficient markets and perfectly rational people. I mean, everyone being rational all the time.
Right. So instead of pretending humans are like robots, he brings human behavior into the mix.
Yeah, exactly. He's not afraid to get into those messy bits.
I like it. So adaptive market, can you give us just a quick overview of what this hypothesis is all about before we jump into the details?
Sure. So Lowe basically argues that financial markets are not perfectly efficient, but they are adaptable. And he sees human behavior with all its quirks and inconsistencies playing a big role in how markets actually function.
Okay, so it's not just about those numbers and algorithms. There's like a human element that we can't ignore. Yeah, exactly. Yeah, we can't just pretend that human behavior doesn't matter when we're talking about markets.
I like where this is going. And Lowe kicks things off with a pretty interesting example, the Challenger disaster. Now, what does a space shuttle explosion have to do with financial markets?
Well, that's what makes this example so interesting. Just minutes after the Challenger exploded, the stock price of Morton Thiokol, the company that made the faulty O-rings, it plummeted.
Wait, so the market knew something was wrong even before any investigations or official reports? How is that even possible?
Right. It's like the market had some kind of sixth sense, right? Economists Maloney and Mullerin actually found that trading in Morton Thiokol was halted by 11:52 a.m. that day. So just 13 minutes after the explosion. And it was because of a flood of sell orders. By the end of the day, Morton Thiokol's stock had dropped almost 12%.
That's wild, and I'm guessing that's a pretty big outlier compared to how it normally trades.
Oh yeah, for sure. It's definitely not typical. And that's why it's such a great example of how the market doesn't always behave in a perfectly efficient way.
Yeah. So this idea that all information is instantly and accurately reflected in prices, maybe that's not always the case.
Right. If that were true, you'd think investors would wait for more information, right?
Yeah.
Before reacting so drastically.
Right. It's like what behavioral economists call herd mentality, right? Where people are just kind of following the crowd, even if it means ignoring logic.
Yeah, there's definitely an element to that.
Yeah.
But I think Lowe's suggesting something a bit more nuanced is going on here.
Okay, so what's he saying?
Well, he argues that these seemingly irrational reactions, like we saw with the Challenger situation, could be a way of dealing with uncertainty. In a world where we don't really know the true odds of anything, sometimes our instincts and gut feelings take over.
So it's less about being perfectly rational and more about adapting to a world where we don't have all the answers.
Exactly. We're constantly trying to make sense of things, even when we don't have all the information.
I'm starting to get a feel for this, okay? But before we get too deep into this adaptive markets hypothesis, let's rewind a bit and talk about the theory that it's challenging the efficient markets hypothesis. So what's the key idea there?
Well, the efficient markets hypothesis essentially says that stock prices already reflect all available information.
Meaning it's impossible to beat the market consistently because any opportunity for profit would just be immediately arbitraged away.
Exactly. That's the idea. And one of the key building blocks of this theory is something called the random walk model of stock prices. The idea is that price changes are totally random and unpredictable over time.
It's like that analogy of the drunkard's walk, right?
Yeah.
Stumbling around, each step random, no clear direction.
Precisely. But here's the thing. Lowe and McKinley, they did some research that kind of threw a wrench into that idea. They developed a statistical test for the random walk model using 20 years worth of market data.
And what did they find?
Their findings actually contradicted the random walk hypothesis. They found that the variance, that measure of how spread out the data is, the variance of 2-week stock returns was 3 times that of 1-week returns.
Yeah.
The random walk hypothesis actually predicts that it should only be twice as large.
Okay, so if it's not random, does that mean there is some kind of order or predictability that we're missing?
That's where the adaptive markets hypothesis comes in.
Yeah.
It acknowledges that markets are not perfectly efficient, and humans were not perfectly rational either.
We're not always making those Spock-like logical decisions.
Not always, no.
Yeah.
And Lou points out a really important distinction between risk and uncertainty.
Wait, aren't those basically the same thing?
Not quite.
Yeah.
So risk is something you can calculate the odds for. Like flipping a coin, there's a 50-50 chance for heads or tails. But uncertainty is when you don't even know what the odds are.
Okay, I think I'm seeing the difference here. So give me a real-world example to help me wrap my head around this.
Okay, so imagine you've got a jar with 100 marbles. You know that 50 are red and 50 are blue. If you bet on the color of a marble that's randomly drawn, that's risk. You know the exact probabilities.
Right, 50-50.
Exactly. But now imagine another jar with 100 marbles. But this time, you have no idea how many are red or blue. That's uncertainty. You're completely in the dark.
Okay. That's a great way to put it. So you're saying financial markets are more like that second jar, full of uncertainty.
Exactly. We very rarely know the true odds of success or failure for any investment. And Lo observed that people are, generally speaking, more comfortable with risk than with uncertainty.
Yeah, that makes sense. When you don't know the odds, it feels more like gambling than a calculated risk, right?
Right. And in those situations, our behavior might seem irrational, but it could actually be an attempt to adapt to that inherent uncertainty.
So maybe instead of panicking when we see something like that Morton Thiokol stock plunge, we should try to see it as like a natural response to an uncertain situation.
That's one way to think about it. We're not perfect, but we are constantly adapting to the information we have. And that's really a key insight from the adaptive markets hypothesis.
Okay, I think I'm starting to wrap my head around this whole adaptation thing. But if we're all just kind of flying blind, how can anyone actually make sound decisions in a system that's constantly changing?
That's a great question. And it leads us to another important concept, behavioral biases. Even when we try to be rational, our brains are wired in ways that can sometimes lead us astray.
Oh, yeah, those pesky biases. Like confirmation bias, right? Where you just gotta see what we want to see.
That's a classic one. Lo also talks about something called probability matching, which is this tendency to match your choices to the probability of events, even when a different strategy might actually be better for you.
So even when we know the odds, we don't always make the most logical choice.
Exactly. Think about it this way. There was this classic example from World War II. Bomber crews had to choose between wearing a flak jacket or a parachute. And data showed that being shot down was actually more common than the plane being hit by shrapnel.
So logically, more crew members should have chosen parachutes, right, to increase their chances of survival.
You'd think so. But what happened is crews ended up roughly matching the probability of those events. So more chose parachutes, but still a significant number were opting for those flak jackets.
Wow, that's fascinating. Even with the odds laid out in front of them, they weren't necessarily making the best choice from a purely statistical point of view. Does Loa give any other examples of how our supposed rationality can kind of break down?
He does. One that always sticks with me is this coin flipping experiment that was done at the University of Chicago. Victor Niederhofer, he observed this group of, really smart graduate students. They were playing this simple game where they just had to predict heads or tails.
Sounds straightforward enough. What's the catch?
Well, these students, with their understanding of statistics, they should have known that the odds of getting a long streak of either heads or tails were incredibly low. But what did they do? A lot of them kept betting on those long streaks, thinking they could somehow outsmart the odds.
So even these brilliant minds fell for the gambler's fallacy, thinking that past results could predict future ones. That's kind of comforting, actually.
Right. It's like, okay, even the smartest people can make these kinds of mistakes, especially when there's money on the line.
This is making me rethink some of my own investment decisions. So is there any way to overcome these biases? Or are we just doomed to repeat these mistakes over and over again?
That's a great question, and one that we'll definitely explore further as we keep unpacking the adaptive markets hypothesis. But for now, I think the key takeaway is that recognizing these biases is the first step towards mitigating their influence.
Okay, so awareness is key. Got it. I am definitely hooked. Let's keep diving. What else does Lo have for us?
Well, next we're going to get even deeper and explore how neuroscience can help us understand how emotions impact financial decision-making.
Neuroscience. Sounds intense. I'm ready. Let's go.
Okay, so we're back and ready to go even deeper with this adaptive markets hypothesis. You mentioned neuroscience before the break. I'm really curious to hear how our brains are actually reacting when it comes to money.
Yeah, this is where things get really fascinating. You see, to really understand how emotions play into financial decisions, we need to look at what's going on inside that brain of ours. Our brains are wired to process things like fear and pain in a very, very primal way. Those fight or flight responses we have.
Right, like we're programmed for survival. That makes sense.
Exactly. But here's the really interesting part. even social rejection activates some of the same brain regions as actual physical pain.
Wait, so you're saying that the pain of, let's say, losing a bunch of money on a bad investment could trigger a similar response to like a punch in the gut? Ouch.
Huh?
Exactly. And that's why financial losses can feel so devastating, right? It's not just about the numbers, it's an actual physical experience in the brain.
Wow, okay, so our emotions are definitely playing a role here, but does that mean we're just like slaves to our biology when it comes to money?
Not necessarily. Remember, the adaptive markets hypothesis is all about adaptation, right? So while we might have these predispositions, we can also learn to recognize and manage those emotional responses.
So it's kind of like becoming aware of our own internal wiring and then developing strategies to avoid those knee-jerk reactions.
Exactly. And that's where understanding those emotional patterns that Lowe talks about, things like that fear, greed, and financial crisis cycle, that can be really helpful.
Okay, I'm intrigued. Tell me more about that cycle.
So imagine the market is doing great, right? Everyone's making money, feeling good, optimistic, and our brains, they get flooded with dopamine, that feel-good chemical. Suddenly we're invincible. We start taking bigger and bigger risks.
We get hooked on those wins and we just keep chasing that high, right?
Yeah, and that can lead to these bubbles, where asset prices get inflated way beyond any reasonable valuation. But then what happens? The party ends, the market takes a downturn.
And that's when the fear kicks in, right? We're terrified of losing all those gains we made.
Exactly. And that fear can be just as powerful as the greed that drove us to take those risks in the first place. And what happens? Panic selling, market crashes.
Yeah.
Boom and bust. We've seen it time and time again.
It's like a pendulum swinging back and forth between irrational exuberance and then blind panic. It's kind of crazy when you think about it. And I guess even those seasoned professionals aren't immune to this, right? I mean, think about Chuck Prince's famous quote about dancing while the music is playing.
Oh yeah, that's a classic example. He was clearly caught up in that moment, unable to see the warning signs or maybe just choosing to ignore them.
It's that FOMO, right? That fear of missing out. We talked about herd mentality earlier.
Exactly. But even when we understand these patterns, these cycles, it can still be so hard to resist those urges, those primal urges, right? Especially when the pressure's on.
So what can we do? Does Lom offer any solutions?
He does. He doesn't just point out the problem, he also tries to find ways to address it. And one of his key takeaways is that awareness is really the first step.
So we need to acknowledge that our brains are wired in a way that can sometimes lead to less than optimal financial decisions.
Exactly. We need to understand our own biases, and then we can start to develop strategies to mitigate them. One thing we can do is try to build systems and safeguards that take those biases into account.
So instead of just relying on willpower, we create structures that help us make more rational choices.
Exactly. For example, something as simple as having a predetermined investment plan can help you avoid making those impulsive decisions based on fear or greed in the moment.
Right. You've already thought through your strategy, you've set your goals, so you're less likely to be swayed by those market swings.
Precisely. And this whole idea of building systems to overcome our limitations, that's really a core theme in the adaptive markets hypothesis. It's not about being perfectly rational. It's about being effectively adaptable.
Okay, I'm liking this. But I want to go back to something you mentioned earlier, that idea that even experienced traders aren't immune to these emotional influences. Lowe has this anecdote in his book about observing traders in a real-time trading simulation, right?
He does. He was watching both seasoned traders and also an MIT student who were playing this game. And he noticed they were all showing very similar skin conductance responses, which basically means their bodies were reacting in a very similar way to the stress and excitement of the market.
So even though those traders were pros, they were exhibiting the same physiological responses as the student. That's wild.
It is. It kind of suggests that even with all the training and expertise, our brains still react to financial risk in a very basic, primal way.
Wow, that's a humbling thought. Experience can only take you so far, I guess. But Lowe's hypothesis isn't just about individual behavior, right? He also talks about how financial markets themselves are a product of adaptation.
That's right. He describes the evolution of markets as a kind of natural selection. So certain strategies, certain institutions, they thrive in a particular environment. And then others, they fail to adapt and they essentially become extinct.
Okay, this is where I start to imagine dinosaurs and meteor strikes. Give me a real-world example of this financial evolution in action.
One of the most striking examples is the rise of hedge funds. Liu sees them as a form of financial evolution. They're constantly innovating, adapting, trying to find new ways to exploit market inefficiencies.
So hedge funds are like those scrappy mammals that survived the extinction event, while the dinosaurs, those traditional investment firms, they couldn't keep up.
I like that analogy. But here's the thing. Even hedge funds are subject to these same evolutionary pressures. Even the most sophisticated strategies can become obsolete if they fail to adapt to changing market conditions.
So nobody's safe, huh?
Nope, not even the big players. And that brings us to long-term capital management LTCM. Remember them, that highly leveraged hedge fund run by Nobel Prize winners.
Wait a minute, those guys got it wrong, the Nobel Prize winners.
They did. Their strategy was based on exploiting those tiny market inefficiencies. But then a bunch of unexpected events happened in the late 1990s, like the Russian financial crisis, and it all came crashing down.
So they were basically over-optimized for one particular set of conditions, and when those conditions changed, their whole strategy backfired.
Exactly. Their collapse is like a cautionary tale. It shows us that even the smartest people with the most sophisticated models, they can still get it wrong. Adaptation is key, even for the best of the best.
This is starting to feel very Darwinian survival of the fittest in the financial jungle. So what separates those who thrive from those who just survive, or worse, go extinct?
It always comes back to adaptation. Those who learn from their mistakes, anticipate change, and adjust their strategies, they're the ones who tend to come out on top.
So it's not enough to just be smart. You got to be adaptable. You got to be willing to change your approach.
Absolutely. And that leads us to a really important question. How do we apply all this to those major financial crises, like the one we saw in 2008? That was a global earthquake, right? How does the adaptive markets hypothesis help us understand something like that?
Yeah, that's a big one. I remember that housing bubble, right? Everybody and their brother thought real estate was a sure thing.
Right, and that belief, that was driven by a whole bunch of factors, right? Low interest rates, easy credit, and then all this financial innovation. It created a situation where more and more people were piling into the housing market, driving prices up. And that just reinforced the idea that it was a risk-free investment.
It's like a self-fulfilling prophecy gone wrong. Everyone kept dancing, like Chuck Prince said.
Exactly. And as prices kept going up, lenders, they started lowering their standards. And they created these increasingly complex mortgage-backed securities that, in hindsight, we know were basically ticking time bombs.
So it wasn't just about individual greed, it was about a whole system that had adapted to this particular set of circumstances, a system that was ultimately unsustainable.
Exactly. And the adaptive markets hypothesis helps us see how this kind of systemic risk can emerge, even when individual actors are behaving in ways that seem totally rational at the time.
Okay, so if those seemingly rational actions can lead to something as disastrous as the 2008 crisis, how do we prevent something like that from happening again? I mean, if the system itself is prone to these kinds of breakdowns, what can we do?
That's the million-dollar question, isn't it? And it's one that Lowe spends a lot of time thinking about. He argues that those traditional forms of financial regulation, the ones that focus on individual institutions and their behavior, they might not be enough to prevent these large-scale systemic failures.
So instead of just looking at individual players, we need to look at the whole system.
Exactly. We need a more holistic approach.
Yeah.
One that considers all those complex interactions within the financial ecosystem.
Okay, so where do we start?
Well, Lowe introduces this concept of behavioral risk management.
Behavioral risk management, what's that all about?
It means recognizing that our biases, those quirks in our thinking that we've been talking about, they can contribute to systemic risk. It's about understanding how things like probability matching, hyperbolic discounting, all these cognitive biases can actually lead to those unintended consequences on a much larger scale.
So we need to shift our focus from just trying to regulate those individual institutions to really looking at the system as a whole and try to identify those potential points of failure where those human biases can really amplify that risk.
Got it. It requires a real shift in our thinking. Moving away from that focus on individual rationality to understanding how our collective behavior can shape those market outcomes.
Okay, I'm with you. So it's not enough to just set up some technical regulations and build some fancy risk models. We need to actually factor in the human element.
Absolutely. And that means understanding how things like narratives and culture can influence financial decision-making.
Narratives and culture, how do those fit into all of this?
Well, think about the stories we tell ourselves about the market. The narratives that shape how we see risk and reward. These stories can be so powerful, right? Sometimes they can really lead us astray.
You mean like that whole housing prices always go up narrative that fueled the 2008 bubble?
Exactly. That narrative, it was so strong. It blinded so many people to the real risks that were involved. It created this false sense of security.
It's like we all got caught up in this fairy tale, and then the clock struck midnight and reality hit.
That's a perfect analogy, and that's where culture comes in. The culture of Wall Street, with its focus on short-term gains and risk-taking, it can make those biases even worse and lead to more of those dance while the music is playing moments.
So it's not just individual psychology, it's also about those shared beliefs and norms that shape behavior within the entire industry.
Exactly. And Losi, he actually uses the example of the Madoff Ponzi scheme to show how a toxic culture can enable and conceal fraudulent behavior.
Yeah, the Madoff case was a huge wake-up call. How does the adaptive markets hypothesis shed light on what happened there?
It really highlights the importance of understanding how cultural norms can influence things like oversight and risk management. In that case, you had a culture within the SEC that was very deferential, maybe even complacent, and that allowed the fraud to go undetected for years.
So it wasn't just about Madoff being a master manipulator. It was also about a system that was kind of blind to those warning signs, caught up in its own biases.
Exactly. The adaptive markets hypothesis really drives home the point that financial markets are not immune to those same cultural influences that shape every other aspect of human endeavor.
Okay, I'm starting to see the big picture here. But how do we actually move from theory to action? How do we build a more resilient, more equitable system? What does Lou propose?
Well, he suggests a multifaceted approach. First, he emphasizes the need for a more adaptive approach to regulation, one that actually considers all those behavioral and cultural factors we've been talking about.
So we need a system that can evolve and respond to those ever-changing dynamics of the market instead of just trying to set static rules.
Precisely. We need regulators who understand behavioral science, who understand how stories and culture can shape behavior. And they need to be able to anticipate and mitigate those emerging risks.
Okay, that makes sense. But regulation alone isn't going to solve the problem, right?
You're right. Lowe also talks about the importance of education. We need to educate investors about the risks and rewards of different financial instruments. We need to educate regulators about behavioral insights. And we need to foster a culture of long-term thinking within the industry itself.
So basically, we need to give everyone the tools and knowledge they need to make more informed decisions, both individually and collectively.
Exactly. And finally, Lowe really stresses the importance of transparency and accountability. Financial institutions need to be held responsible for the risks that they create.
So we need to make sure that the incentives are aligned in a way that actually promotes responsible behavior and discourages those excessive risks.
Exactly. It's about creating a system where those who benefit from risk-taking are also the ones who bear the consequences when things go wrong.
This has been a really eye-opening conversation. We've gone from this simple view of markets as rational and efficient to this much more complex and nuanced understanding of how human behavior really drives financial outcomes.
And that's the power of the adaptive markets hypothesis, right?
Yeah.
It challenges us to question those assumptions, embrace complexity, and find new ways to harness the power of finance for the benefit of everyone.
Okay, I'm ready for the final leg of our journey. What are those key takeaways from Lowe's work? And what's that one final thought you want to leave our listener with?
Okay, so we've really gone deep with this adaptive markets hypothesis. What are some of the big things that someone should walk away with after listening to all of this?
Well, it all goes back to why we started this whole deep dive, right? We were questioning that classic view of markets being these perfectly rational and efficient machines. And what Lowe really shows us is that human behavior, it's not just some random noise in the system, it's actually a fundamental driver of how markets work. So ditch those simplistic models and accept the reality. Humans, with all our biases and emotions, are actually a part of the picture.
Exactly. And it's not just about recognizing that we're not always rational. It's also about understanding that we're adaptable. We learn from our mistakes. We change our strategies, and we can even build systems to help us make better decisions.
So adaptation is key, not just for individuals, but for the whole system.
Right. And that brings us to the last big takeaway. The financial system, it's complex. It's not just about the numbers and the algorithms. It's about psychology, culture, those narratives we tell ourselves.
Right.
All these interconnected factors, they all influence how markets behave.
So we're talking about this living, breathing thing, right? Constantly changing and adapting.
Yeah, that's a great way to put it. And because of that complexity, there's always going to be risk. We can't predict everything, we can't control everything, but we can get better at understanding and managing those risks.
That makes sense. So we've ditched the simple models, we've brought humans back into the equation, and we've acknowledged how complex this all really is. where do we go from here? I mean, does Lowe give us any solutions, or are we just going to keep repeating the same mistakes over and over again?
Lowe's not just pointing out problems. He's actually got some ideas about the future of finance. He talks about using the power of markets to tackle some of the biggest challenges we're facing,
You're talking about those mega funds he talks about, right? Those huge pools of capital that are focused on things like climate change and curing diseases.
Exactly. He thinks we can use financial innovation to actually do good in the world while also making the system less risky. These mega funds, they'd be set up to encourage long-term investment in areas that traditional markets tend to ignore or underfund.
So it's about directing resources towards solving problems that could really benefit everyone.
Right? It's a bold vision, but it's based on the ideas of the adaptive markets hypothesis. He's basically saying that financial markets aren't inherently good or bad, they're tools. And like any tool, it depends on how you use them.
I like that. It's not about getting rid of finance, it's about using it in a smarter way. So how do we make this happen? Where do we even start?
Laura emphasizes a multi-pronged approach. Adaptive regulation, education, and a change in culture within the financial industry itself. We need regulators who really get the complexity of the system and how human behavior plays a role. We need investors who are educated about risk and taking a long-term view. And we need a financial industry that values things like sustainability and social impact, not just profits.
So we're talking about a real shift in how we think about things, both individually and as a society.
Exactly. It's about moving away from that short-term, profit-at-all-costs mentality and toward a more long-term, purpose-driven approach. It's a big challenge, but it requires collaboration from everyone.
This has been an incredible deep dive. We started by questioning the rationality of markets, and now we're talking about how finance can help solve the world's biggest problems. Thank you so much for taking us on this journey.
It's been a fascinating conversation. It really has. And for you, dear listener, I want to leave you with this. Laurie closes his book by sharing his personal goal to be like Harvey Lodish, the biologist whose work has really impacted human health. And I think that's a great question to reflect on. How can we use the insights from the adaptive markets hypothesis to not just understand our financial past, but to create a better, more sustainable, more equitable future for everyone?
It's a great question, and I hope our listeners will take some time to really think about that. Until next time, keep learning, keep exploring, and keep adapting.